Short selling is a financial strategy used by investors and traders to potentially profit from a declining stock price. The process involves borrowing shares of a stock from a broker, selling the stock in the open market, and then buying the shares back at a low price to return the borrowed shares and keep the difference as profit. Here is the short selling process. Borrowing shares. The first step in short selling is to find and borrow shares of a stock that you believe will decrease in value. Investors can borrow shares from their brokerage firm or from other investors who own the stock. Selling the stock. Once the shares are borrowed, the investor can sell them on the open market, pocketing the proceeds. This sale creates a short position in the stock, meaning the investor is betting that the stock price will fall. Covering the short position. To close out the short position, the investor buys back the same number of shares that were originally borrowed and returns them to the broker. The difference between the sale price and the purchase price is the profit made from the short sale. It's important to note that short selling is a high-risk strategy, as there is theoretically no limit to how much a stock's price can rise. If the stock price increases instead of falling, the investor will incur losses, potentially unlimited losses, as the price can continue to rise. In conclusion, short selling is a way for investors to potentially profit from a declining stock price, but it's also a high-risk strategy that requires careful consideration of market conditions and the financial stability of the stock being sold short.